potential shift here, trading like it's 2026, not 1996. Today I want to show you something that I've been hesitant to share because it feels like I'm giving away a secret. It's that important. It's not some bullshit magic system. I'm not going to tell you nuclear stocks are about to go up 300% this year or some other BS. This is real advice, genuinely helpful, and a big part of the risk management puzzle. If you watch no other video of mine, please stay on board for this one. I hope it changes the way you look at markets, and if you have an open mind and some sort of ability in statistics, which I'm assuming you do, this video should help you be profitable long term. Today we are looking at sizing, one of the three pillars of risk management, along with outs and selection, SOS. Here's what matters when it comes to sizing, the heart of it, okay? You can still have a very real and a very significant edge. Let's say 60% of your trading ideas are correct, and still blow up your account with absolute mathematical certainty if you are risking anywhere near 35% of your bankroll on any one trade. Why? In a word, variance. Let's get to the proof. Here we have a coin flip game, link included in the description. Your coin is weighted in this game. It wins 60% of the time and only loses 40% of the time. A huge edge. You start with $25 in your bankroll, and you can set your wager each time to be an exact percentage of your remaining bankroll. This is what happens when you bet 35% of your bankroll again and again, mind you, with a 60% edge. It takes a little while to reach $10,000 and about half that time to reduce it to $57. Good luck, any trader out there mentally recovering from that sort of variance. Let's set our auto bet amount for 30% and see what happens. As you can see, built up our bankroll to 15K. And in short order, we are back down to $430. Again, mentally unrecoverable. All right, 40% auto bet size. This time, we don't even climb that much higher, only to 3K before variance kicks in. And when it does, it completely wipes us out. I hope I'm making my point clear here. The more you bet, even with a strong edge, the more likely you are to go broke. That's math. Plain and simple math. One last example. Risking only 5% of your bankroll on every trade, a number that I happen to recommend. Let's see what happens. What happens is smooth, non-nervous breakdown, non-life destroying growth. You never see a 50% pullback here, the kind of pullback that destroys traders. Just a nice, even, higher trajectory. A 60% win rate is basically a license to print money, right? The casinos do it. Unfortunately, we are not casinos. We do not have an unlimited bankroll. The percentage of our bankroll that we are risking on any individual trade has an enormous impact on our ability to stay in this game and not go broke, and more importantly, not go crazy and go off the rails. I mean that, seriously. You have to respect variance, and you have to respect your bankroll size every single time you place a trade. Every time you place a trade that risks 20, 25%, 30% of your bankroll, you have to know, and I mean know, that whether that trade is profitable or not, it was a losing trade. If you make that bet over and over and over again, it will leave you broke, or felt it, as some of us former poker players like to call it. All right. I hope this has driven home the mathematical certainty of losing your bankroll when you begin to bet percentages up in the 20, 25%, 30 plus range. All right. It is simply not sustainable. 5% is where you want to be. 10% maybe at most if you absolutely love a trade. All right. It's so, so important. And I hope that the video I've shown you here presses that home. All right. Protect first, profit second. Potential shift here.